That's usually a signal that the economy is going to end up in trouble. It could be a slow-moving crisis, or are we talking about a hard landing? But I do think the markets are stepping back and saying, is that all there is? What else could happen now?
In today's video, ARK CEO, CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
The bad news is, 2 days after Silicon Valley Bank went under, along with Signature Bank, the Fed raised interest rates 25 basis points. The Fed has never before this time raised interest rates in the middle of a crisis. And here again, they're talking about another 25 basis points in early May. With today, I think it was Christopher Waller coming out. He's at the St. Louis Fed and talking about inflation just being way, way, way too high. Fiscal policy. The debt impasse still seems to be out there, and it looks like raising the debt ceiling, the imperative will come sometime in June, we think. So we'll have another few months. It doesn't seem like there's much movement at all. And yet we know that Republicans and Democrats don't want to go through another 2011 where the ratings agencies downgrade our debt. So we assume they'll figure it out, but so far, very little movement there. The one thing that is becoming clear, and this is really a throwback to the early days of my career, the bank crisis seems to be facilitating, in a sense, what we used to call crowding out back then. Really the public sector crowding out the private sector. And how is that happening? Well, we're seeing deposit outflows from the banking system, so that's the private sector, into money market funds and especially treasury securities, a little bit of a flight to safety. So what is that doing? It's actually accommodating spending, government spending. And so we're watching this carefully. If it's accommodating government spending, what will it be crowding out? And we'll get into this in a moment, but it does seem already that the commercial real estate space is one of the victims. So this could be just a slow-moving crisis. We don't know. But getting into monetary policy, it could be a slow-moving crisis, or are we talking about a hard landing? And I think, the markets are a little bit on pause now, trying to figure out, did the Fed and the FDIC come in and, rescue the banking system from a run on the banks? So far, so good. But I do think the markets are stepping back and saying, is that all there is? What else could happen now? And there are a lot of things we think that could happen now. So let's, on monetary policy, as I've reviewed ever since February of 21, M2 growth on a year-over-year basis peaked at 27%. In early 21, February of 2021. Now remember, when COVID started, the fear was that the global economy was going to shut down and go into a depression. And so fiscal and monetary policy makers around the world moved into action, and 27% money growth in the United States was one outcome. But the money growth rate started falling pretty rapidly. And over the last 2 years, it's dropped 30 percentage points. We're now down roughly 3%. That's negative on a year-over-year basis. We have never seen a 30 percentage point decline in the growth rate of M2 on a year-over-year basis, ever. And we have also not seen negative year-over-year M2 growth since the 1930s. So that was the time of the Great Depression. So we're taking this seriously. And we have been taking it seriously, as I think you will recall, for the last year. To listen to the CEO of Citibank say that, wow, who could have seen this coming? And the FDIC and the Fed acted with such alacrity. She was full of praise. But actually, you could see this coming. And we've been talking about it for a year. Credit default swaps started moving up. So those are bets on bankruptcy, or their insurance policies against bankruptcy. And they started moving up last spring as the Fed started to raise interest rates. And they started moving up on banks, all banks, including the money center banks, to the point where last October, I was saying, what is going on? JP Morgan's credit default swaps are getting close to where they were in the middle of the COVID crisis. So the credit default swap market was saying something's wrong out there. And we were also looking at the yield curve. So the yield curve inverted in July of last year and continued to invert and into, really, we got to more than 100 basis points. So long-term interest rates, as measured by the 10-year Treasury yield, were 100 basis points or 1% lower than short-term interest rates as measured by the 2-year Treasury note. And so that's usually a signal that the economy is going to end up in trouble and that inflation and interest rates will come down fairly dramatically. And so that happened last July. Still, the Fed didn't pay any attention to it, it seems to us. And then in October, we wrote a letter just raising some of the issues or the conflicting evidence out there. We had credit default swaps going up, the yield curve getting more and more inverted. We had commodity prices of all kinds coming down. So that's, the early stage of the inflation pipeline. And we just asked the Fed, look, please consider there is conflicting evidence out there, and your votes, it would seem, should not be unanimous to go up 75 basis points at a clip, shocking the financial system. Well, something did break. And we all know, of course, it was the regional banking system. And it has highlighted two major mistakes that banks made. Both of them actually were very understandable, but they were mistakes nonetheless. And they made those mistakes in the middle of COVID, as the crisis was unfolding. They took a look at the Fed's forecast through the end of this year and saw that the Fed was forecasting that interest rates would go nowhere. They'd stay very, very low, move hardly at all. And so it made sense back then to take the gusher of money coming out of fiscal stimulus and ending in bank accounts and put that in very safe, long-term, government-backed securities, yielding 1.5% or so. Remember back then, the Fed funds rate was 0 to 0.25. So it made sense back then. So the first assumption they made was that interest rates would not go up very much, if at all, which is what the Fed was telegraphing. And of course, in 2022, and over the course of just 1 year, interest rates went up 20-fold. Never happened before. 20-fold, up to 5%. That was a shock to the banking system because with such low-yielding securities on the asset side of the balance sheet, it was very difficult for them to pay up for deposits on the liability side of the balance sheet. And so what happened? What happened was deposits flowed out and into money market funds, so out of the banking system. Now, Silicon Valley Bank happened for a little bit of a different reason, that failure. It was a venture capital funding drought. And basically, these startup companies that were banking at Silicon Valley Bank needed to fund their operations because they couldn't get any liquidity events going from the venture capital market itself. And so they started drawing down their deposits to run their businesses. But that got everybody then focused on what deposits were doing in the rest of the banking system. And lo and behold, the entire banking system was seeing deposit outflows for the same reason. The deposits weren't paying much. And the rest is history in terms of the bank crisis and everything that we had to do around that. So now we come to this question of, okay, here we are now. What happens? Surely there have to be some ramifications, economic ramifications. And we can see them now in the commercial real estate market, which from what we're hearing is basically frozen. And we're beginning to see more strategic defaults and fire sale prices, anecdotally. So that's one area that we know is having problems. Why? Well, if you look at the loans to the commercial real estate market, somewhere between 60 and 75% of them, depending on who's measuring, emanated from the regional banking system. So that's a problem.